Hey, everybody, you're going to want to listen in to this full episode of the Note Closer Show. We've got tax planning and rock star, tax deduction expert Ron Fossum joining us on the podcast from taxplanwealth.com. He shares some knowledge bombs that you'll want to listen to the entire episode because he shares some things that we can all do differently to get bigger write-offs or bigger deductions so we pay less to Uncle Sam. So listen to the full episode. Make sure you share it with at least one person. And while you're at it, go ahead and leave that 5-star review and hit the subscribe button. But listen in, you're going to love this episode, and we'll see you here on at the top, everybody.
This is the Note Closer Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, Scott Carson, excited to be here with you today. And I'm jacked up to have a buddy of mine on here to talk about something that will keep you up at night. It'll scare you sometimes, at least one day of the year. Many of you probably are sitting there sweating because you probably haven't done your stuff the last 2 years with everything going on. But who knows what you're doing as an entrepreneur? It's something that we all have to do as entrepreneurs, as good tax-paying Americans, to pay our part so that everybody else can be a freeload. No, I'm just joking. But I'm honored to have my buddy here join us. He serves as a fractional CFO for numerous companies, as well as running his own tax planning service, taxplanwealth.com. His company's entire focus is how to reduce their clients' tax bill by, guess what, 50% or more, legally, morally, and ethically, everybody. Additionally, he frequently speaks on the subjects of corporate veil and asset protection, real estate, and due diligence processes for investment. So we're glad to have my buddy here join us from out of Lake Stevens, Washington, the one, the only, the tax man, the myth, the legend, Mr. Ron Fossum. How's it going, buddy?
Fantastic, man. That's a lot to live up to. Thank you.
You know, I am available for birthdays and introductions.
That's awesome.
It's awesome. Now, so Ron, besides what I just shared there, what would you say for our listeners? Because we got a lot of real estate investors, we got a lot of note investors into this. Why don't you dumb it down what I just said a little bit for folks to share kind of what your nuts and bolts are for you?
Yeah. So it's what most people end up doing is just waiting to the end of the year. They turn everything into their tax preparer. Maybe they're a bookkeeper, maybe they're an accountant or tax prep person, CPA, EA, IRS enrolled agent, EA. But it's all done after the fact. So it's very reactive. And then we turn everything in, we wait a couple of weeks, maybe a month or something, and we're just biting our nails trying to figure out what we owe. Bless their hearts, the CPAs and the EAs have a super hard exam. Remember when we go to a big city like LA or San Francisco, and these old yellow page phone books were like 3 inches thick?
Some short people will use them to sit on to drive cars. Or so.
Yeah. So like the CPA study guides is 4 manuals like that. And there's not a single thing in there that helps them identify how to reduce taxes for their clients. It's all about how to properly identify the source of the income, how to record it properly, what forms to file it on, all that stuff, and the time frames that certain forms have to be filed. It's super complex, and reducing their taxes is not normally their focus, and especially if the business owner, the entrepreneur, is doing it after the fact. So tax planning is where all the savings happens. So we're more of a proactive approach. Like right now, this is our crazy season. This is our busy season right now because everyone's trying to get all these strategies done so the cash flow that looks proper gets into the books properly. So by the end of the year, whatever gets in the books is what ends up on the tax return.
Right, because you basically end of your fiscal year for most people comes the end of the year, or what is it, the end of the first quarter a lot of times, depending on what's going on, right?
Yeah, so we've got another 4 months to go to really get whatever's left is there. We can't wait to December to squeeze everything in.
Now, what's one of the biggest things that you see, or maybe a couple things that when you sit down with entrepreneurs, whether it's real estate investors or business owners, some things like that, what's one of the biggest things that you are surprised that they're not doing or things that they can do to help ethically reduce and legally reduce their tax income. We're not talking about cooking the books, but
Yeah.
you know what I mean?
Well, let's look at a big picture. What do the Fortune 500 companies do? You look at in 2019, companies like Starbucks, Amazon, Penske, Prudential, Pitney Bowes, Chevron, Delta, Netflix, Alaska Airlines, Levi's, all these companies made billions of dollars in revenue and paid zero federal tax. And they all have shareholders and they're all highly scrutinized because they have shareholders. So we know they're doing it legally. And so that's really our secret sauce is we look at what do these Fortune 500 companies do? How can we start to boil that down? And to your question, one of the best things people can do is seriously look at the entity structure they have. And I think you've had Laughlin on here before, right? You've had Aaron Young. So I'm not going to beat this horse, but your entity structure, the IRS admits that over 70% of taxpayers would be better served in a different entity than what they're currently filing. And so maybe it's not just one entity, maybe it's multiple entities. We have the new, it's not so new, but when Trump passed his tax plan, we get that QBI deduction, 20% straight across the board that starts to phase out if you make too much in one income. So sometimes you just go in and start to bifurcate income and do some of your business in this entity, some of your business in this entity, so that you stay under that threshold and you get 20% on both of that. And the phase out, if you're married filing joints, like 357 or some odd number, but 20% of 300 grand, like that's a $60,000 deduction. Who cares if it's going to cost us a few $100 to file an extra an entity or something like that?
Yeah, or if you're in California, you got to pay $800 a year because we hear people that complain about living in California. I'm like, listen, that's your good weather tax, unless you're living in like burnout area where it's on fire for the most part. But yeah, I mean that's the thing. It's a cost of, we all know that Aaron likes to talk about prepare with the end in mind. You know what I mean? Yep. And that's one of the things that you talk about. Hey, let's look at the end and see how you help prepare. That's like you separate off the LLCs, changing your strategies, not all combined into one. There are advantages to having that multiple LLC structure, not only just asset protection, but actually tax planning, you're saying here.
Oh, absolutely. It's a common question I get, especially when I speak live to an audience is, which entity is the best entity? And I'm like, they're all good. Like they all have their advantages. But why marry your business to just one? There's just no reason for it. So like in an accounting firm, we'd put accounting in one business. We'd do tax prep in another business. We'd do tax planning in another business. So they're all going to qualify and then all be separated, which also helps for the asset protection piece, in the event of litigation and that kind of stuff as well.
And I was, where was I at? We were watching something popped up on TV the other day. I was watching a TV show or HBO, and The Accountant popped up. One of my favorite movies with Ben Affleck. And there's that scene where the lady at the revenue office is trying to track down, the wolf guy, Ben Affleck's, and finding income and names and stuff like that, and then seeing how he structured his business over, delegated income across, what is it, the Asian restaurant, his tax, or Chinese restaurant,
laundromat,
yeah, his tax planning, and a couple others that were all businesses to help separate things out, and he paid taxes mostly legally on that. But it's a great example of, like you said, bringing everything in and over maxing out one thing, separating things out so you can multiple max it out. Correct? Yeah.
Probably the second most common thing I see that's missed is from a corporate world, you probably heard of a corporate expense account, right? When the employee takes a customer out, and then he can expense it back to the company gives him the money back. The IRS calls that an accountable plan, but you can do that as a small business owner. You can set up your own accountable plan and submit for reimbursements. So this will be your home office, your mileage, your cell phone, your travel, all that stuff that if it comes in your personal name, ends up on a personal credit card, you submit it as an expense to the company, and then the company reimburses you. And then when that money flows out of the business and comes back to you personally, it's not payroll, it's not salary, it's not wages. You bypass all the taxes. And so it's one of the few areas of the code, it's completely deductible for the business and tax-free to the business owner. And so really looking at what you could do for reimbursements as another way to start sucking some money out of the business.
Yeah, and you start looking at one of the biggest things that people are doing, besides travel costs, is mileage. If they're driving around and looking at properties, or it's part of what they're doing, being able to credit their mileage, that's a big write-off for us. When we were traveling, when I was traveling across the country for 3 years straight, driving a lot of times, I had a big mileage discount.
Yeah,
And it adds up quick.
there's a myth around, especially because of COVID. If I work from home, I don't have that many business miles. And the reverse is actually true. So yeah, if it's just your house and you commute to your job, that's commuting and that's never deductible. There's no workaround. However, if you have a home office, that becomes your first place of business. And now you go to another work location, temporary work location or permanent work location, doesn't matter. That mileage goes from commuting non-deductible to instantly deductible.
Wow.
You just need to leave with a profitable intent in mind, that's going to be added to your business. So your mileage frequently will be in this 70-80% of your mileage should be deductible if you start to compound stack some of these strategies, right? Because you're doing the home office, now you're going to qualify for more mileage. Because you're doing the mileage, you're going to qualify for the reimbursement piece, right? And so you can start to, that's where this really starts to get powerful, is when you stack these strategies together.
Yeah, that's a big one. I didn't know that. That's actually a ding, because I had an office here down the street, and home office now, we're deducting square footage of where we're at here versus everything else, the mortgage, the utilities, all that good stuff too. But
Yep.
that's a new one there on the mileage from the house, since it's the office, as long as you claim that and go on that route. Yeah, that can add up. I have to go back, even though I don't drive my truck very much, everything's done remotely.
Yeah. Probably the other one that is done a lot, like everyone's heard about home office, but done improperly, this is probably the number one, is there's 4 ways to write off your home office. And most people, if they're doing the taxes themselves, they've probably taken it right off the tax return. It's just $5 a square foot, which is the simplified method, safe harbor method. And the IRS says, hey, if you use that method, we will never use that as a foundation for an audit. But when you look at the square footage method, like you mentioned, that almost always comes out better, especially if you're in any of the states that ever border an ocean. Like some of the Midwest states, and it's a lower value property, it might work. $5 a square foot might work out. But the gross square footage is one method. That's the second method, right? So $5 a square foot, gross square footage method. There's also a net square footage method, and then a equal size of rooms method. And I've never found I shouldn't say never, but it'd be unusual to find equal amounts of rooms that are like, the master bedroom is always bigger, right? Your kitchen's not the same size as your dining room and all that stuff. But this net square footage rule allows you to take off all of the common areas out of your house. So if you live in a 1,500 square foot house, the gross square footage method is saying, hey, I got a 100 square foot office, 1,500 square foot house, I'm going to take that percentage. If you take that same house, 1,500 square feet, you pull out the common areas like your hallways, your stairs, your landings, your entryway to the front door, entryway to the back door, the bathrooms. If you've got a server room in your house, if you've got a utility room that has the hot water tank and the heater, air conditioner, whatever, you take out all of those common areas. So you're just left with the main rooms. You've shrunk that 1,500 square foot house down to 900. Now you've still got this 100 square foot office. Divide that into a smaller number, you get a higher percentage. You'll usually pick up 25 to 35% more off every line item that you get with the home office. So that's going to be your internet and your insurance and your taxes and the interest on your loan and all that stuff, your maid service.
Somebody showing up to wash and clean.
Yeah.
Delegation at its finest. Those are the first things you should be delegating.
Yeah. The lawn and the laundry.
Yeah, the lawn and the laundry, things you should not be doing. Now, can that be a write-off for the lawn boy to come mow the yard if it's at your office? Now, one of the great things that people we'll flip it here a little bit is in real estate investors, and being able to write off the real estate or the depreciation on the assets. A lot of people they love that when it comes to real estate. We don't necessarily have that in the note business unless you take a property back, and then you can start doing that. But let's talk about that. You have the straight depreciation, but there's also another way to depreciate your assets out there too, correct?
Yeah, absolutely. You can accelerate that depreciation. So normally, let's just start high level first. If you got a residential property, you're depreciating that, or deducting, it's another word for it, depreciating that over 27 and a half years. And you're literally just slicing it like it's a $100,000 house. You slice it 27 and a half times. That's what you're getting as a depreciation that year. Effectively looks like a deduction. It's technically a little bit different.
Right.
But not everything in the house is going to live 27 and a half years. And so we can go in and do a analysis of that property and say, hey, the windows are going to last 15 years. The carpet's going to last 5 years. The driveway, the fence, the roof, would probably stay at the 27 and a half years. So we can start attaching ages to all of that stuff. The stuff that comes up with a 5-year, 7-year, 10-year type time horizon, we can accelerate that value of that whole thing all the way up. So it increases your depreciation, which then decreases your taxes. That's phase one. Phase two is, that's just if you're a real estate investor. If you're a real estate professional, which means you do 750 hours a year and you materially participate in your business and you spend more than 50% of your time in this real estate business, you can have another job. You work 900 hours doing something else, like you're a doctor, a lawyer, or whatever else, but you spend 950 hours in the real estate profession, regardless of being an agent, has nothing to do with an agent. You're just documenting your hours that you spend in this time in the real estate business. Now, all of that accelerated depreciation not just counts against the rents of those properties, it also counts against your W-2 income. And so it's frequently, you'll start to see, the more you look for it, right? As soon as we become aware of something, we start seeing it all over the place. You see highly compensated individuals that are also qualifying as a real estate professional. And there's a whole set of rules to jump through for sure. But all of that depreciation, accelerated depreciation, like you mentioned, then wipes out that W-2 income, and they can be pulling multiple 6 figures a year. I've got one client doing 7 figures a year.
Wow.
and getting to zero.
Wow.
It's
kind of like when you start looking for something to see something, like looking for like a yellow Porsche, it suddenly starts showing up everywhere, right? Kind of like the yellow Porsche. Is that a yellow Porsche car behind you?
Yeah. Nice. Not my best investment, but it was a lot of fun.
Well, you gotta have a little fun, I was watching something on HBO last night talking about sports cards and all these things. These people are doing sports collectibles and making 6 figures off of that, and how the FBI and IRS are showing up to make sure they're getting their fair share. People aren't cheating anybody out of the system, with fraud or stuff like that too. So,
yeah.
What's the biggest things that drives you bonkers? Is it you get people come to you too late in some cases, or not early enough to set things up? You mentioned earlier, hey, it's not too difficult for a little bit to get your right entity set up or a separate entity set up. Bringing somebody on to help kind of with this tax planning, it's like being offensive in your tax planning versus like most people being defensively.
Exactly.
Let's talk about that, because you do that for a lot of entrepreneurs, being a fractional, a C-suite employee, or I don't want to say employee, but person for them. Let's talk a little bit about that and how that works.
Yeah, probably the part that drives me bonkers is the I'm just going to throw my own industry under the bus. The accountants, the CPAs, the EAs. I was talking with someone yesterday, and they said their accountant only wanted them to write off 50% of their hotel, even though it was 100% for business use. And I'm like, 50% for hotel is not a rule anywhere. Like 50% of meals can be a rule. Most of those have been switched. So we got a new meal plan with Trump's tax plan, and now we've got a new meal plan with Biden's tax plan. It's only good for 2 years, and then it's going to revert back to Trump's tax plan again. So meals and entertainment, you got to watch really closely. But they're trying to help out restaurants and hotels, right? So a lot of those 50% rules went over to 100. But just the amount of misinformation And this industry, it just drives me nuts. I feel like I spend an inordinate amount of time going. And so when we do a strategy in your tax plan, we explain it literally in high school English. There's no acronyms or legal mumbo jumbo. All right. We've explained the strategy step by step. And then we conclude every strategy with here's the IRS code. There's usually multiple code sections that will refer to it. The court cases we can find, treasury opinions, all of that stuff is all sourced on every single strategy. And so I just went and grabbed the plan, grabbed that section, sent it over to them. And I'm like, that's not a thing.
Is it also, you also think it's also because the tax code is so long? Something I think I saw somewhere where it was like over 6,000 or 6,500 or 7,000 pages deep with all the different U.S. tax code. And it's not, I don't think it's really designed in a lot of cases for people. It's more than that, you're saying, okay?
Pre-COVID, it was 73,000 pages. Since COVID, it's over 25,000 pages additional.
How is anybody ever supposed to keep, or they're not supposed to keep up with that, are they?
Yeah, the first couple bills that got passed, I read those things like, you just can't keep up. They just keep passing stuff, and it's a couple thousand pages, and you're like, I'm going to hit the high points, or I start delegating it out to the team. So fortunately, on our team, we've got CPAs, we've got accountants, we've got bookkeepers, and we also have 4 tax attorneys on our team. And so we start, okay, you take this chapter, you take that chapter, and let's all come back together and share some of these strategies.
Well, that's the beautiful thing about having a team, adding a team like you guys to an entrepreneur out there, is to help them understand. You know, somebody out there, solopreneurs, entrepreneurs, business owners, they're best, as we know. If you've ever read, what is it, the E-Myth by our buddy over there.
Gerber.
Yep, Gerber. That it's not our best interest to be going back and looking at the research and development, I guess you could say, of the tax code. It's all about face forward and planning, but that's also planning for these type of changes, right?
Yeah, absolutely. I had to go back to 1986 to find this one, but it started out as we're going to date ourselves now. Remember in 81, Reagan took office, and it was Jimmy Carter exiting, Reagan there. And the first week of his presidency, he was able to negotiate the release of 55 hostages from Iran. They had been hostages for 444 days. And the IRS came down super heavy-handed on these poor 55 individuals, because being held hostage in a terrorist country is not a reason to file your taxes.
Hey, welcome home. You got a big tax bill.
So, that was 81. It took to 86 for Congress to pass something. And so it was a terrorist relief act is what it was in 86. And the whole act was 2 pages, super clean. I'm like, oh, I get this. But then over the years, they just said, hey, if you're the victim of a terrorist, you get these breaks. If you're the victim of a hurricane, well, you should get those breaks too. If you're the victim of a tornado, earthquakes, volcanoes, like anytime there's this declared disaster zone,
right,
this section of the code now qualifies. And I haven't heard this on any other podcast, anywhere else. No one's talking about this at all, because I had to go back 30 years to find it. But it's very applicable. It's still only 2 pages long. It's a super simple piece. And there's only 2 times I ever tell clients this: you don't need receipts in this section of the code. It literally says, and it was confirmed in 2001 with the Joint Committee of Taxation, no receipts are required if you're using this section. So was it March? I think it was March 13th last year is when they declared COVID a disaster zone nationwide, right? A year and a half ago, sorry.
So that's why you would say maybe with the emergency or the EPPL, so if they were approving stuff, basically whatever you filled out in a lot of cases, which for a lot of people was good, but you also had people trying to take advantage of that in other cases out there too, correct?
Well, that was, that's free money from the government. So that was the PPP and the EIDL loans and that kind of stuff for sure. The disaster relief money I'm talking about is your business. So, hey, I've got a couple rentals. I've got a notes business. I've got an LLC that's taxed as whatever. Me personally, I can submit as an employee of the business or an individual of the business, I could submit some of these even personal things and have the business pay for it. The business gets the deduction. The business does not have to issue a 1099, and you personally get that money tax-free. It's not income. So one of those examples, if you start the sentence with, because of COVID, because of quarantining, I have this new extra expense, it's probably going to be covered here. So if I've got some clients that their kids were in college, they paid for the whole thing, and then COVID hit and they got kicked out of the dorms. So they have this new temporary housing expense that they're having to pay twice. That's totally deductible. Another one would be like tutors. My kid, I don't have kids, but if the kid was used to getting some one-on-one care with the teachers, but they went to Zoom, can't get one-on-one, so they had to hire a tutor to come into the house, that tutor is going to fall under this disaster relief. That's because of quarantining. Because of quarantining, I couldn't go to the gym, so I had to go buy an elliptical machine. I had to go buy a treadmill. Personally, I had to go buy a massage chair. I couldn't go to my chiropractor. I couldn't go to my massage therapist. And so I bought one of those monster massage chairs. That bad boy's in my living room.
We know what you're doing at night. Lay down.
Yeah. Those things are worth it.
Self-care. Way to fight COVID. Self-care, basically.
Even food supplies, like non-perishable food supplies, right? I'm sure your family's the same way. We've got a cupboard full of stuff just in case the grocery store gets empty. CDC says we should have some food reserves. So all your non-perishable food supplies, a certain amount of days, how many members in the household. If you got 5 members, that's probably, $66 a day is what the IRS gives everyone for travel on food. So that's a reasonable number. So if I use $66 a day times 30 days, that's $19.80. If I get 5 people in the household, that's almost 10 grand
right there for that aspect of it. That's a lot of MREs, man. Well, that's a lot of beef stroganoff and vegetable lasagna,
Yeah. So that's just some of what passed during all this COVID, the new 25,000 pages that they've added.
But those are such relevant things. People don't think about that. And I think so many people come from accounting as intimidated as they're embarrassed on what they don't know. Yeah. And I think a lot of people have that, I don't know, I don't look like an idiot in hiring somebody and they've seen all my dirty laundry that I haven't taken care of or washed. You know what I mean?
Yeah. Part of some of your listeners could do is to hold their accountant and CPA to ask a better question is don't ask, can I write this off? If they don't know, the answer is going to be no, for sure.
Right.
And none of us, at a high school reading level, it would take like 32 years to read the whole code. Like, I don't know it all. No one's read the whole thing. So ask a question like, everything's deductible somehow, some way, right? And so what are the circumstances that would have to be for this to be deductible is a much better question. Make him go do some research. And if he's unwilling to do the research, you probably don't have the right guy, the right gal.
Amen. If they can't give you an honest answer, yeah. I think that's what you say. A lot of people say, I don't know. You can't. Well, it sounds like a realtor when you ask them outside the box question on how to structure a deal. No, you can't do that. It's illegal. No, you can't write that off. Wait a second. There's got to be some legal room in here in a lot of ways out there. What's probably one of the things you see people get slapped on the wrist for? I mean, besides pre-COVID in a lot of ways, Ron. Trying to deduct too much outside the box kind of stuff or stuff that's not in their main wheelhouse or?
Yeah, because they feel like they're paying disproportionately more of their fair share. They start to play in areas, I don't believe in the gray zone. I think everything is very clear in the code. Right. It's red lights, green lights, and yellow lights. Like you go to irs.gov, you look up any strategy and you start reading it through, there'll be caution. Literally, it says caution and it'll have an explanation paragraph. That's a big yellow light, right? So I understand how in 20 years ago, I was this way. I felt like, man, why am I paying between state and federal, 30, 40, 50% of my money? That's really hard to build a net worth that way when you're giving 50 cents of every dollar away. And so they start wanting to do cash or squeeze things in as deductions that aren't deductible. there's no legitimate business purpose for it. There's so many legitimate, honest, ethical ways to do it. There's no reason to play, hide it from the IRS game. It's just silly. That will come back to bite you sooner or later. And if your accountant and CPA is playing that game with you, that tells you a little bit about their ethics as well. So let's try to play nice. Let's play by the rules. I mean, look at it this way. Congress and senators write the rules. They're not going to write the rules that hurt themselves, or they're going to leave more rules for their constituents and the people that have donated them money. So there's always going to be a legal, moral, ethical way to do it. And so as stuff changes, we just need to find the new path. Mm-hmm. Right? We've had more tax change from Trump's tax plan forward to now Biden. It was what, in the last 2.5 years than we've had previously 30 years. Like Ronald Reagan was the next largest, biggest change in the tax code. And so if we're doing the same thing all over again and we're taking the same deductions, we're probably missing a small fortune, and we're definitely overpaying.
Yeah, that's the thing. It's a good sit down and have an advisory. What kind of advisory? Somebody who knows what the heck they're talking about. When you look at your clients, what's a starting point that you work with? Are we talking income levels, businesses? You're starting with the solopreneur, working your way up. Is there an income level that really makes sense for them to bring somebody on like you and your team to help them out?
Yeah, it just depends on who the team they need based on where they're at. So some clients, I'm working with a client right now who's doing $20 million in revenue. He's got a great bookkeeper. He's got a CFO, but the CFO doesn't know anything about tax. And so I'm a CFO for a CFO, which is fantastic. So we just kind of fill in wherever they're at. If they're starting up and they can't afford a full team, that's great. Then we've got some do-it-yourself tools so that we can keep everything in alignment, make sure you maximize that kind of stuff. Our tax plans are kind of built to be a standalone. So even if you have a team and you're like, hey, I got a 20-year relationship with my guy, he's awesome, but he's not proactive. So just give me some ideas that I can kind of feed him with, and we want to start getting some of this stuff implemented. The tax plan all by itself can just be a standalone. So you can just call us and say, hey, I'm a real estate investor. I'm a notes investor. I want to know as many strategies as I can find around real estate and notes, right? And then we can give you all the tax code, all the strategy, make it super simple. We'll even jump on the phone with them if they've got questions after they've read the plan. And but if they don't know it, they can go read all of our source material and still get it done for you. So
that's awesome. I love it, man. That's a great way to be kind of I don't want to say it fits all sizes, but you've got a solution for anybody out there, no matter where they're at and what their history.
Yeah, that's
a beautiful thing, man.
Yeah, it's kind of fun. I tell you, I got into this.
That was my next question. How'd you get into what you're doing now from where you're at before?
I did what I would like to think a lot of people do. The first time they get money is you spend it. Like I bought some stuff for family and we did some travel and all this kind of stuff. And so the first time I made $300,000 a year, and I did what everyone did. I got to the end of the year, turned everything in. They say you owe 30%, right? You owe $100,000, and I freaked out because one, I didn't have the money, right? And two, I freaked out was like, this cannot immediately. Once I got past the first thought of I spent that, the second thing I thought of was this cannot be how wealthy people do it.
Right.
You cannot be given 30, 40, 50% away and build a net worth. And so I started getting on this, I just went on a mission of what does everybody do? So you've got, 2010, Warren Buffett made $39 million and only paid 17% tax. Are you freaking kidding me? This belief that the more you earn, the more you pay is just hogwash. That's what your accountant tells you when he doesn't want to go do his job for tax planning. So, and maybe it's not his job. Maybe the tax planning piece is separate than the accounting. Maybe you've only engaged him for the accounting and that's all you're getting. That could be it as well. But but yeah, how do wealthy people earn millions and millions of dollars? And so for us, we want to be efficient. So if you're in this, 15% to 20% range, you're probably pretty efficient. If you're keeping 80% of your money, 85% of your money, you can build a real net worth. I don't know, zero can't be the right number for everybody, or we wouldn't have a government, we wouldn't have roads, police, fire, teachers, all that stuff. So when it works out that it's zero, that's always kind of fun, but not everybody can get by with zero for sure.
Well, but that's the thing is, you said it very clearly. When the Wizard of Omaha is making 39 million, but only paying 17%, that's well below what as everybody was saying. And that's it's sad, and I may be opening up a Pandora's box here, but the whole national argument that you got to pay more, you didn't pay any taxes, I think is so childish. Is because look, the tax code's there to help identify opportunities for us to write things off, and people get so bent out of shape that people don't pay taxes, or what's Trump's tax returns, or whoever's didn't pay anything. Well, there's a reason for that. Is they use legal avenues to pursue this, to make things happen. I mean, what is a few years ago, it was all about the Roth IRA with I can't remember what his name is, Romney. You know what I mean? That he's got self-directed Roth IRA with some things. Well, he did it legally, and it always sees that it's not the hey, congratulations. It's shame on you. You owe me because I'm not smart enough to do the same thing.
He also, that was one of them. The other one that he got a lot of flack for was being a fund manager, which also applies to anyone in your group that's doing a syndication, whether it's for notes or real estate or anything else. If you're a fund manager, then they call it earned interest, right? And so it caps out at 15%. It's not ordinary income. And so forget the brackets. So he made several $1 million in 1 year and only paid 15% on that income. And they were like, well, how come so low? That's one of the lowest brackets. And he's like, well, those are the rules.
Yep.
Earned interest, I think is what it's called.
Yeah, it's earned interest income. Yeah, definitely.
Yeah.
I'm in the process of putting one together myself and going through that with my fund coach, basically, as we're doing that and setting that stuff up. So yeah, that's the thing is, if you spend that, I've never regretted spending $1 on asset protection, tax planning and stuff like that. It all comes back exponentially in one form or fashion and help you in the long term, doesn't it?
Yeah, absolutely. Like it's complicated enough to run a business. You can't be the jack of all trades and go figure it out yourself. So I'll hire the attorneys to get the stuff done. I'll hire the Laughlins of the world to help me with the entity structures, and rely on other people that do it all day, every day. Clearly, they're going to do it better than you.
Right. Now, one of the things too that we've had some of our students reach out to, because they've screwed up. They haven't filed their taxes, and they have a tax lien placed against them. That's not the end all be all of that. A lot of times you can go back and redo your taxes, or file actually to get those removed, or reduce it, or put on a payment plan in some cases too, can't you, Ron?
There's 9 ways to negotiate with the IRS. And it depends on a lot of the facts and circumstances of your case, for sure. You're dead right. Depending on the timing of the year, you can either go 2 years from the date the tax is paid, or 3 years, and refile those years if you found out you made a mistake. And they even pay you a small interest rate. It's nothing to be excited about, but I mean, where else in the world Ron screws up, files his return, and then a year later, I screwed up, I get my money back plus interest. That just doesn't happen anywhere else but the government.
Well, and that's a beautiful thing with what's going on in the world. Like you just said, all the stuff with COVID, being able to write off stuff in a disaster area, it's well worth people taking a look at what they filed last year, and then what they're thinking about filing this year to be proactive in it, correct?
Absolutely. And even if they remember when they came out with the PPP and the employee retention tax credits, they said, hey, if it's one or the other kind of thing. The second round, they changed that, and most people missed it. So even if you took PPP money, you can still go back and get the earned employee retention tax credit, ERTC credit. So yeah, it absolutely is worthwhile going back and look and making sure you've taken everything. In fact, regardless of your relationship, I would have your returns looked at every 3 years, regardless. Even if you stay with your guy, But having a second opinion is totally normal with our health. Why not with our finances?
Our financial health. I love it.
Yeah.
I think we might have to call the episode getting your financial health second opinion. You just became the financial health doctor there. Dr. Ron Fossum. Open up and say,
Yeah. One of the things our team did is we work with Golden Tax Relief quite a bit. And the owner of the company, under the Freedom of Information Act, he went and got the auditor's training manual. And so call it what it is. If you have the other team's playbook, you should be winning most of your games, right? Like, you know the rules. And so if someone hasn't filed 2 or 3 years, or if they've got a lien, a levy, or garnishment or something, it's absolutely worth talking to someone that is an expert in that. I'm more of a planner, windshield, move forward kind of guy. He's a genius in how to go backwards and clean this stuff up. And maybe you have that lien because your accounting was done wrong. It amazes me, never ceases to amaze me. He looks at balance sheets and income statements and tax returns, and he spots a mistake crazy fast. But yeah, you can absolutely just play by the rules, and the rules are there. But you got to understand what game you're playing. It does no good if you're playing football with a basketball. You can't score. You don't know the rules.
Exactly. Well, but it's also too what you can and cannot do, whether you can pass forward or pass back or whatever, how you can take some of these creative things, not creative, but true rules of passing your taxes on or splitting, doing all that kind of stuff and looking back. And it's such a great opportunity and great rules to play by. It's and we could call it tax instant replay. You know what I mean? In a lot of cases. Yeah,
for sure. And this is where, like, you've heard Aaron talk about, doing the minutes and the resolutions every month. There's probably something going on very routinely. You got to document your annual shareholder meeting. You got to document most of your major decisions, some of your routine decisions. Well, there's a tax piece that goes along with that. So if you just have a meeting, Scott has a meeting with Scott, and you're just talking to yourself. If you're the only person in your company, you can have a meeting. You're supposed to have a meeting. That's what Starbucks does. They have a meeting. That's what Apple does, right? They have a meeting. It's just they've got 30 people, but in your company or my company, maybe it's just one of us. It doesn't matter. The rule's the same. You have the meeting. The IRS says that you can have 14 times a year, you can rent out your personal house to anyone in America and have tax-free income. And anyone in America can be your business if that business has its own EIN number. So you have your social security number, your business has its EIN number, you're separate under the law. And so that's where what Laughlin does with entities and what we do with taxes is we're looking to try to align all of those things. You said it earlier, there's offense and defense. And getting those teams to play together is very effective. You rarely see championship teams that don't have a solid defense, right? So that's where they come together.
I love that, but that's a great analogy to put it all together for everybody there. Hey, you're there. Even that last tip, most people didn't realize, up to 14 times a year, your entity can rent out your house to have your annual, your monthly or quarterly meetings and pay what market rent for the day, basically, to your house for that or for the office.
Yeah. So you would call based on the square footage of your house, the whole house. Don't confuse this with home office because that's just a percentage of, right? So your whole house is rented once a month to your business, and to get that number, it would be this total square footage of the house. And we would call some hotels and say, hey, if I am in a 1,500 square foot house or 2,500 square foot house, how much is a 1,500 or 2,500 square foot conference room, or how much is a 2,500 square foot suite upstairs, and get 2, 3, 4 comps of what your rates are, and then keep those comps, write yourself a lease, right? Expense that. It's in your ledger entry. It goes over to the business as corporate room rental. That money comes out of the business deductible, comes over to you completely tax-free.
I love it. Cha-ching. Hang on. That's worth the cha-ching on that one right there.
Well, and look at the cost to implement that one. Like, it's a few pieces of paper and a couple of phone calls. like the biggest bang for your buck is that one. There's 8 steps total to implement that one all the way through. So don't miss any of those steps. But the biggest bang for your buck is almost always that 14-day one. Plus, it adds to your asset protection. Without those meetings, amendments, and resolutions, they're going to pierce your corporate veil. They'll come after your personal assets, and it's just garbage from there.
Yeah, good stuff there. Well, Ron, what's the best way for folks, our listeners and people watching, to connect with you or your team, or to find out, make a phone call or touch base with you to set up and see if they're a fit for it, or start picking your guys' brains and putting you guys to work, I guess is the best way to say.
Yeah, they can reach out to us on Facebook, just Tax Plan Wealth. On Facebook, they can taxplanwealth.com. There's a contact us page. Our office is 425-381-2253, 425-381-2253. And if you just let us know if you want planning and or accounting or resolution, we can make sure that if it's not me, that we can hook you up with the right person for sure.
Awesome. Good stuff there. Guys, check it out. All those links will be below in the comments or on the blog there for you to be able to grab and put it to work there. So as you said, Ron, next 4 months are really busy, and it's a good time to start planning now for next year. Start looking back now to make sure you're not missing anything out when taxes come due next year, correct?
Absolutely. Don't wait till the last minute.
Yeah, there you go. All right, guys, that's going to wrap it up for this episode of the Note Closer Show. Go out, take some action, reach out to Ron and his team. You'll feel a lot better. You'll be enlightened, and you might even actually be excited about all the opportunities that you're missing out and the less taxes that you got to pay to Uncle Sam or your state if you're in a state income tax basis as well for you. So go out, take some action, and we'll see you all at the top, everybody. Bye.
Thanks, buddy.